Right now, roughly 1 in 4 global 2000 companies have just completely paused their artificial intelligence rollouts.
Yeah, to hit the brakes entirely.
Right. They're looking at these massive server costs, the, highly experimental software, and they're just deciding that the return on investment simply isn't there.
It's a huge capital drain for a lot of...
Exactly. Yet, in the middle of this massive corporate hesitation, there is one IT consulting firm that just posted $29 billion. Yes, billion with a B in future bookings.
Which is wild.
It is. They are essentially guaranteeing their clients that they can make artificial intelligence pay for itself. So today we are tearing into Cognizant Technology Solutions. Ticker symbol is CTSH, and we're looking at their Q2 2026 earnings call.
It's a fascinating divergence, really. You have this broader enterprise market that is just terrified of tech spending right now. And then you have this specific company just, accelerating.
Right.
What we're seeing in this single earnings report is essentially a real-time stress test of the global technology consulting model.
And that is exactly why we're doing this today. So welcome to a special Talk Tickers edition of The Deep Dive, customized specifically for you, the retail investor, who just wants the Wall Street jargon stripped away.
No spreadsheets here.
Exactly. Normally, earnings calls are incredibly dry, right? Like a CEO reading a script, a CFO listing off numbers. But when we looked at the notes on this Cognizant call, we realized this isn't just an update on their quarter. This is really a blueprint for how business-to-business software pricing is permanently mutating.
Yeah, the entire model is shifting.
So we're going to rip through the data, decode the corporate speak, and figure out what this shift actually means for your portfolio. But, we have to start with the foundation. You can't know where stock is going without knowing where it just landed. So give me the headline numbers.
Right, let's get into it. So for the second quarter of 2026, Cognizant reported revenue of $5.5 billion.
Okay, 5.5.
Yep. That represents a 4.1% increase year over year in constant currency. And crucially for Wall Street's expectations, that hit the absolute high end of their own internal guidance.
Okay, I want to pause on that for a second. Constant currency, because, companies love to throw that term around to make their numbers look better.
They absolutely do.
Right. If Cognizant is a global company and they're paying developers in, say, Indian rupees or euros, but they're billing clients in US dollars, well, currency fluctuations aren't just like math on a spreadsheet. They actually impact the hard cash in the bank. So why do we as investors just accept this constant currency metric?
Well, it's a fair pushback. You are absolutely right that actual cash flows are impacted by foreign exchange rates. You can't spend constant currency.
Exactly.
But as an investor trying to evaluate the health of a business, you really want to know if the management team is successfully selling more services and operating efficiently, right? Or if they just, got lucky because the Federal Reserve changed interest rates and the US dollar weakened.
Oh, I see.
Right, so constant currency basically strips out all that macroeconomic noise. It acts as a pure operational picture. It tells you that, strictly operationally speaking, they sold 4.1% more than they did exactly 12 months ago.
Okay, fair enough. It shows the actual demand for the business hasn't magically disappeared just because currency shifted.
Exactly.
So the top line is growing steadily, if not explosively. What about the bottom line?
Moving down the income statement, their adjusted earnings per share came in at $1.37.
Okay.
It's a 5% increase year over year. But the metric that really matters here, the absolute profitability engine, is their adjusted operating margin, which landed at 16%.
16%. I'm looking at the historical data here, and 16% seems to be a pretty significant threshold for them.
It is. It represents a 40 basis point expansion year over year.
And a basis point is just 1/100%, right?
Right. So their margin grew by 0.4%. But, the story isn't just this single quarter. It's the trajectory. This marks their 6th straight quarter of margin expansion.
Wow. 6th straight.
Yeah. In an environment where technology budgets are under intense scrutiny, they are proving they can consistently wring more profit out of every single dollar that comes through the door.
Okay, but hold on. Because I read the transcript too, and I saw some incredibly messy accounting hiding right behind that super clean 16% number.
Yeah.
The adjustments.
Right. The CFO mentioned an $84 million charge for something called Project Leap, and then, like, almost simultaneously, an $81 million benefit from an Indian labor code reversal. I mean, that sounds like they are just shuffling massive amounts of money around to make the quarter look pretty.
It definitely looks messy on the surface, which is exactly why they report adjusted metrics, right? To isolate those weird one-off events from the core business.
Right.
But you're right, you cannot ignore them entirely because they reveal management's actual strategy.
So let's look at Project Leap. What is that? Project Leap is a structural cost-cutting program. They spent $84 million on it this quarter, and the vast majority of that, between $50 and $55 million, went directly to employee severance.
Severance?
Yeah. And the rest went to optimizing real estate and software licenses.
Okay, this is exactly what I want to challenge here. Firing people to save $55 million in severance might make the margin look great this quarter, but doesn't that just destroy institutional memory?
It's a risk, for sure.
Right, because if Cognizant's entire pitch right now is that they are building highly complex, bespoke artificial intelligence systems for massive global banks, don't they need veteran engineers? How do we know this isn't just cutting into the bone?
That is the critical risk with any corporate restructuring. But what management argues, and frankly what the broader shift in the IT services industry supports, is that the type of talent they need is fundamentally changing.
Changing how?
Historically, the IT consulting business model was built like a massive pyramid. You had a few highly paid, brilliant architects at the tops designing a system, and then thousands of entry-level coders at the bottom of the pyramid, just manually typing out basic code, line by line.
And billing the client for every single hour those thousands of people worked.
Precisely. It was a numbers game. But generative artificial intelligence absolutely destroys the bottom of that pyramid.
Because the AI can write the basic code.
Right. An AI coding assistant can write boilerplate Java or Python instantly. So Cognizant doesn't need armies of manual coders anymore. They're trimming that historical fat.
Okay, so who are they hiring then?
What they need now, and what they are aggressively hiring and training for, are what they call frontier business operators.
Frontier business operators?
Yeah. These are employees who sit at the intersection of business strategy and technology. They don't just write code. They manage blended teams of human experts and digital AI agents.
Ah, so the severance isn't just like indiscriminate cost cutting. It's a painful but necessary rotation of the workforce. They are swapping out manual laborers for heavy machinery operators, so to speak.
That is an excellent way to conceptualize it, yes. And then regarding the $81 million benefit you mentioned.
Right, the Indian labor code thing.
That was purely a stroke of regulatory luck. Years ago, they recorded a massive liability based on the India defined contribution obligation, which is essentially money they legally had to set aside for employee benefits based on local labor laws.
Okay.
But in Q2, the Indian government notified subsequent regulations, and Cognizant realized they didn't have to hold all that money in reserve anymore, so they were able to reverse the liability.
So they basically found $81 million buried in a regulatory filing cabinet.
Essentially, yes.
Yeah.
Just found money. But to management's credit, they were completely transparent about it. They excluded that windfall from their adjusted operating margin.
Okay, that's fair.
Yeah, so when they say they hit 16%, that is the core business operating efficiently. It excludes the cost of firing people, and it excludes the lucky regulatory refund.
Okay, I buy the margin expansion. I think that makes sense. But here is the ultimate question for literally any technology company right now. Is the growth real? Or is it a mirage?
Yeah.
Because we established at the beginning that the overall market is pulling back on IT spending. Companies are scared, so if Cognizant is growing, we need to know exactly who is opening their wallets and why.
To answer that, we have to look at the segment data. And the most glaring number in this entire earnings report comes from their financial services division.
The banks.
Yep. That segment surged nearly 12% year over year in constant currency. And this is not a one-off anomaly. It is their second consecutive quarter of over 10% growth in that specific sector.
Why does Wall Street care so much about the financial sector? I mean, why isn't retail or manufacturing the benchmark?
Because the massive global banks, the insurance conglomerates, the capital markets firms, they're the most technologically sophisticated and technologically demanding institutions on the planet.
They have to be.
Right. Their IT budgets are astronomical. But their spending discipline is ruthless. They do not fund science projects. They don't buy technology just because it looks cool in a PowerPoint deck.
So bank IT spending is essentially the foundation pour of a skyscraper. It tells you exactly how big and how stable the rest of the market intends to build. If the banks are buying, the technology is actually delivering a real return on investment.
That is exactly how analysts view it. When a major bank commits hundreds of millions of dollars to an IT consulting firm in this macroeconomic environment, it signals immense confidence in the vendor's ability to drive actual business value.
And the momentum is really building there.
It is stark. Ravi Kumar, Cognizant CEO, pointed out that their financial services growth went from high single digits last year to over 9% in Q4, to over 10% in Q1, and now to 12%. He described the segment as running hot.
But it isn't just revenue they've already built, right? The future pipeline is what really caught my eye in the report. The transcript mentioned their trailing 12-month bookings hit $29 billion.
A massive number.
Let's make sure we define this clearly for the retail investor. Bookings represent the total contract value of the deals they have legally signed but haven't actually performed the work for yet, correct?
Correct. If revenue is looking in the rearview mirror, bookings are looking through the windshield. And a $29 billion backlog is a massive indicator of future stability. They also reported a book-to-bill ratio of 1.3.
Meaning for every $1 of revenue they actually collected this quarter, they signed contracts guaranteeing $1.30 of future revenue. You just don't get a ratio like that unless clients are signing massive multi-year commitments.
And that is exactly what is happening. The composition of those bookings is vital. They signed 7 mega deals in just this one quarter.
What's a mega deal?
It's classified as a single contract with a total value exceeding $100 million.
Wow. 7 of them in one quarter.
Yep. And importantly, 3 of those 7 mega deals were brand new logos.
Which means they won entirely new clients rather than just renewing existing relationships.
Right. They are taking market share.
Okay, this brings us to the absolute core of the issue and, frankly, my biggest point of skepticism.
Let's hear it.
Every single technology CEO right now is legally obligated to say the word AI 50 times on their earnings call to keep their stock price up.
It does feel like a legal requirement, doesn't it?
It's an epidemic of corporate buzzwords. So I want to know if Cognizant is actually generating real margin from artificial intelligence, or if it is just a marketing wrapper on the same old consulting work. Because you mentioned earlier that a quarter of massive corporations are actively pausing AI rollouts.
And an analyst from Goldman Sachs brought that exact contradiction up on the call.
Really?
Yeah, the analyst pointed out that corporate boards are looking at the staggering cost of running these generative models, what developers call token consumption. And they are balking.
Okay, I want to break down that phrase token consumption because it is critical to understanding the economics of modern tech. If I am using a model like ChatGPT, the computer breaks my prompt down into tokens, which are essentially fragments of words. And the AI company charges me a tiny fraction of a cent for every single token the computer has to process to give me an answer.
Exactly. It's the raw cost of computational power.
Right.
You know, the electricity, the server cooling, the processing time.
Right. So if I am the CEO of a Fortune 500 logistics company and I pay millions of dollars for an enterprise AI license and my employees are just using it to write slightly more polite emails to vendors.
Or to summarize a PDF that they could have just read themselves.
Exactly. I am burning millions of dollars in token consumption for absolutely zero measurable increase in profit. No wonder companies are pausing it. It is a massive capital drain.
Yeah.
So how is Cognizant securing $29 billion in bookings against that headwind?
Because they have recognized that exact dynamic, and they are pitching a fundamental shift in how artificial intelligence is deployed. The CEO refers to this as the transition from the first chapter of AI to the second chapter.
Okay, what's chapter 2?
Well, chapter 1 was experimental. It was about giving employees chat boxes and just seeing what happened. Chapter 2 is about moving from token consumption to token economics.
Token economics? I mean, that sounds like a cryptocurrency scam. What does he actually mean by that?
He means deploying artificial intelligence in a highly targeted, integrated way that generates hard, measurable financial returns that vastly outweigh the underlying cost of the compute.
Okay, so ROI first.
Right. Cognizant is going to these skeptical corporate boards and saying, look, we know you are frustrated with generic AI. Stop buying chat interfaces. Instead, let us rebuild your core operational plumbing. We will embed intelligence directly into your workflow, and we will guarantee that the efficiency gains pay for the technology.
Wait, they are guaranteeing it?
Yes, and this is the paradigm shift in their business model. They are shifting from selling time to selling outcomes.
This is huge. Let's spend some time on this because if this works, it changes the entire software industry.
It absolutely does.
Historically, an IT consulting firm bids on a project based on hours. Like, if I am a bank and I need my legacy database migrated to the cloud, the consulting firm says, okay, that will take 100 engineers working full-time for a year, and we bill them out at $200 an hour. So the project costs $40 million.
Right.
The consulting firm has zero incentive to do the job faster because if they finish in 6 months, they make half the money.
Precisely. It is a linear model that completely rewards inefficiency. But Cognizant is inverting that structure. The CEO highlighted a massive engagement they just signed with a leading insurance brokerage.
Okay.
Cognizant contractually committed to delivering a more than 50% productivity improvement over 5 years across the client's operations.
So they are going to the client and saying, we will look at this process that currently costs you $50 million a year to run. We will take over the entire process, rebuild it with artificial intelligence, and we guarantee it will only cost you $25 million a year. And you pay us a cut of those savings.
Exactly. It completely aligns the incentives. The client gets a guaranteed massive cost reduction, which eliminates the risk of a failed IT project. But for Cognizant, the upside is nonlinear.
Nonlinear how?
If they quote a fixed price for an outcome, and their internal AI tools allow their engineers to complete the work in a fraction of the expected time, their internal labor costs plummet.
Because they don't need 100 engineers for a year anymore.
Yeah.
They need 10 highly skilled frontier business operators armed with autonomous AI agents, and they get it done in 3 months. They still get paid the massive contract value, but their costs are almost zero. The margin on that specific project must just go to the moon.
That is the core of their strategy. But, and this is but you can only underwrite that kind of financial risk if you are absolutely certain your AI tools are actually capable of doing the work. You cannot bluff your way through a guaranteed 50% productivity improvement.
So how do we know they aren't bluffing? Do they have internal data proving this actually works?
They do, because they are aggressively deploying these tools internally before selling them to clients. The CEO revealed a staggering metric on the call. Over 40% of Cognizant's own internal software development is now AI assisted.
Over 40% of the code driving a $30 billion company is being written or at least heavily assisted by a machine.
Yes, and they are actively tracking the financial impact on their own workforce. They reported that their internal revenue per associate increased by 4.6%.
Wow.
And their adjusted operating income per associate increased by 7.1%.
Meaning every single human being working at Cognizant is mathematically generating more profit for the company than they were 12 months ago.
Exactly.
This completely explains the operating margin expansion we talked about in the first section. The severance packages weren't just a desperate ploy to cut costs. They were trimming the workforce because the remaining employees are supercharged by these tools. They're literally doing more with less.
It is the definition of operational leverage. And this leads directly into how they are scaling this capability for clients, particularly through proprietary platforms. The crown jewel of this strategy is a platform they own called TriZetto.
Okay, I am so glad you brought up TriZetto, because when I was reading their earnings transcript, this seemed like the clearest example of what they mean when they talk about token economics. The financial numbers on this single platform are wild.
It's a powerhouse. TriZetto is their proprietary healthcare technology platform. It generates more than $1.1 billion in annual revenue completely on its own.
$1 billion just from this one platform.
Yep. And in the first half of 2026, it actually grew faster than the overall company average and delivered substantially higher profit margins.
But what actually is it? If I am a retail investor, I know what an iPhone is, I know what a Tesla is. What is a healthcare technology platform?
To understand TriZetto, you have to understand the absolute nightmare of American medical billing.
Oh, we've all been there.
Right. When you visit a doctor, the clinic generates a claim filled with highly complex medical codes, diagnoses, procedures, equipment used. They send that claim to your health insurance company.
Okay.
The insurance company then has to cross-reference those complex codes against your specific insurance policy, factor in federal regulations, check network deductibles, and finally decide if they're going to pay the doctor or deny the claim. That entire decision-making process is called adjudication.
And traditionally, that process requires armies of human claims, adjusters staring at screens, reading medical dictionaries, and manually approving or denying payments.
That's precisely.
It is incredibly slow, massively expensive for the insurance company, and incredibly frustrating for the patient when a human makes an error.
It is a massive bottleneck. So what Cognizant did was take large language models, the exact same underlying neural network technology that powers ChatGPT, and they ingested decades of complex medical billing logic, regulatory frameworks, and adjudication rules. They built what they call an agentic AI.
Okay, let's break down agentic AI, because that is another term that sounds like jargon but is actually a massive leap in capability.
It is.
And normal AI, like ChatGPT, is a passive answering machine. You ask it a question, it gives you an answer, and then it stops. An agentic AI is given a goal, and it has the autonomy to take actions across different software systems to achieve that goal without human prompting, right?
Exactly. It acts as an autonomous agent.
Yeah.
So the TriZetto AI doesn't wait to be asked a question. When a complex medical claim hits the insurance company's server, the AI agent instantly reads the medical codes, cross-references the patient's policy database, applies the regulatory logic, and makes a final adjudication decision in milliseconds.
Milliseconds.
It only flags a claim for a human auditor if the data is fundamentally contradictory or missing.
So they essentially built a digital, autonomous brain for the entire healthcare insurance industry. And they are renting access to this brain.
That is exactly what it is.
Yeah.
And because it is a platform integrated directly into the insurance company's core operations, it is incredibly sticky.
Sticky meaning they can't leave.
Right. Once an insurer transitions to an AI system that adjudicates claims instantly and reduces their administrative overhead by massive margins, they are never going to go back to hiring thousands of human adjusters. It creates a recurring, highly profitable revenue stream for Cognizant. The CEO stated explicitly that TriZetto is their blueprint for how they intend to build and scale platform-led growth across other industries.
And the transcript is packed with examples of them doing exactly that. Let's look at a few of these case studies, because I really want to understand how they're taking this concept of agentic AI out of healthcare and applying it to other massive legacy systems. Like, I read a fascinating note about a pilot program they ran for a large North American bank involving fraud disputes.
The banking sector is a prime target for this. Banks spend billions of dollars every year on anti-fraud measures and KYC compliance.
Whoa, pause. Let's translate for the retail investor. KYC stands for Know Your Customer.
Right.
It is the brutal regulatory requirement that forces banks to prove exactly who is opening an account and where their money is coming from, to prevent money laundering and terrorism financing. If a bank messes up their KYC process, federal regulators fine them hundreds of millions of dollars. It is a massive operational risk.
Exactly. It is high stakes, labor-intensive work. So Cognizant engineered a custom AI solution for this bank's fraud and KYC operations. And this is where the technical architecture really matters. They didn't just give the bank's compliance officers a generic AI chatbot.
Right, that wouldn't help.
They built a system that combines static institutional knowledge,
Right.
like the bank's historical fraud case files and regulatory manuals, with dynamic business context.
How does an AI get dynamic business context?
Through APIs or application programming interfaces. Cognizant wired the artificial intelligence directly into the bank's live, real-time customer databases and transaction ledgers.
Wow.
So when a suspicious transaction occurs, the AI agent doesn't just look at the single transaction. It instantly pulls the customer's entire historical profile, cross-references it against global fraud patterns, and analyzes the network of accounts the money is moving between, all in real time.
It is acting like a hyperspeed forensic accountant. What were the actual results of the pilot? Did it actually save the bank money?
The results were staggering. The pilot demonstrated the potential to reduce manual human effort in fraud dispute management by more than 50%.
50%.
Yes. And for the KYC process, it significantly improved decision efficacy, which means it caught more complex fraud while simultaneously reducing false positives.
I mean, if I am a bank CEO and an IT consultant proves they can cut my compliance labor costs in half while simultaneously reducing my risk of getting hit with a massive federal regulatory fine, I am signing that contract immediately. The ROI is undeniable. What about outside of the financial sector?
Let's look at the pharmaceutical industry. Novartis is a massive global pharmaceutical company that has partnered with Cognizant for over 20 years. They just selected Cognizant for a massive new 5-year engagement to completely transform their global IT operations.
Okay, doing what?
Cognizant is deploying a proprietary platform they call Neuro AI. The stated goal is to transition Novartis from a labor-intensive IT model to a unified AI-powered system centered on intelligent self-service.
Okay, intelligent self-service. Translate that into a real-world scenario for a Novartis employee.
Historically, if a pharmaceutical researcher at Novartis needed a new, secure cloud server provision to analyze a massive data set of clinical trial results, they would have to submit a rigid IT ticket.
The dreaded IT ticket.
Right. That ticket would sit in a queue for days. A human IT worker would eventually review it, manually configure the server, ensure it met strict pharmaceutical data compliance standards, and then email the researcher back. It is a massive bottleneck for innovation.
And under the Neuro AI system.
The researcher interacts with an autonomous IT agent. They simply state what they need in plain English. The agent understands the request, instantly verifies the researcher's security credentials, autonomously provisions the cloud server, automatically applies all necessary pharmaceutical compliance protocols, and hands the keys to the researcher in minutes.
That's
It
incredible.
completely removes the human IT middleman.
That is a massive operational shift. And I noticed they are doing similar infrastructure transformations in the travel industry too. The notes mention a company called Travelport.
Travelport is fascinating because it operates the invisible plumbing of the global travel industry. They run a global distribution system.
Yeah.
When you go to a website to book a flight or a hotel, that website has to query a massive legacy database to find out exactly how many seats are left on a specific plane in real time and what the pricing logic is.
And those back-end travel databases are notoriously ancient and fragile, like built in the 70s.
They are incredibly complex. So Cognizant brought in Anthropic, the artificial intelligence company that built the Claude model, to partner on strategic transformation for Travelport. They are using advanced AI to modernize Travelport's core software development lifecycle and embedding intelligence directly into their retailing and distribution platforms.
So they are essentially teaching a modern AI to speak the ancient language of global airline ticketing.
Exactly.
It is wild to think about the scale of these integrations, but I want to pivot to something that really surprised me in the research: government contracts.
Yeah, that was a big highlight.
Historically, public sector technology is decades behind the private sector. It is a nightmare of red tape and budget constraints. But Cognizant is apparently winning massive deals with the UK government. I saw mentions of the UK Home Office and His Majesty's Revenue and Customs. What exactly is an IT consulting firm doing for a national border agency?
They are fundamentally rebuilding the country's data infrastructure. Cognizant developed and currently supports the foundational data platform that underpins the UK's migration and border control systems.
Wow.
In this recent quarter, they won an expanded contract to handle software engineering, testing, and managed services for the government's critical caseworking systems.
So they're literally building the data pipelines that determine who is allowed into the country and how immigration cases are processed. That is mission critical, high stakes technology. You cannot afford an IT failure at a national border.
Exactly. And the goal of the new contract is to use automation and data architecture to improve the productivity of human caseworkers, reducing the manual data entry that slows down immigration processing.
And then you have the tax agency, His Majesty's Revenue and Customs. Cognizant recently secured a contract valued at more than $250 million over its lifetime.
A huge win.
$250 million from a government tax agency. For what exactly?
The mandate is to help configure low-code services in support of software build and DevOps functions.
Whoa, pause again. DevOps functions. If I am a retail investor, I do not work in Silicon Valley. I don't know what DevOps is, and I definitely don't know why a government tax agency is spending $250 million on it.
It's a crucial concept to understand. DevOps is a combination of two words: development and operations. Historically, in software engineering, you had a team of developers who wrote the code and a completely separate team of operations people who were responsible for taking that code and making it run safely on the company's live servers.
And I imagine they fought constantly. The developers want to push new features rapidly, and the operations team wants to block changes because new code breaks the servers.
Exactly. It creates massive friction and delays. DevOps is a modern methodology that merges those two disciplines. It relies heavily on automation and continuous integration.
Okay.
When a developer writes a piece of code, a DevOps system automatically tests for bugs, automatically checks it for security flaws, and automatically deploys it to the live servers without a human having to manually move files around.
So it is essentially a highly automated assembly line for software.
Yes, and a government tax agency desperately needs that assembly line. Tax laws change constantly. The government needs to update their digital tax portals rapidly without crashing the system that collects billions of pounds in revenue. Cognizant is being paid $250 million to build that automated, low-code software assembly line for the UK government.
Okay, that makes perfect sense. But I want to push back on this entire narrative.
Yeah.
We have spent 20 minutes talking about the software. We've talked about digital platforms, coding assistants, cloud servers, data pipelines. But the global economy operates in the physical world, right? Companies manufacture physical products, they manage physical supply chains, they operate heavy machinery. If artificial intelligence remains trapped on a computer screen, its economic impact is severely capped. Is Cognizant addressing the physical world at all?
I'm so glad you brought that up because it leads to perhaps the most forward-looking, visionary part of this entire earnings call. Ravi Kumar specifically dedicated time to a concept he calls physical AI.
Physical AI?
Yes. He believes we are entering a new domain of autonomous operations where intelligence escapes the screen and begins to govern physical environments.
I mean, that sounds like science fiction terminology for robotics. What does it actually mean in an enterprise context?
He described it as the iPhone moment for robotics and infrastructure. Think about smart manufacturing plants, automated logistics hubs, robotics that can adapt to their environment rather than just repeating a single programmed motion. Cognizant actually just launched a sovereign physical AI platform as a service to position themselves ahead of this wave.
I need a tangible example. How does an IT consulting firm actually deploy physical AI for a client today?
The CEO provided a perfect case study involving a massive global automotive manufacturer.
Okay.
Over the past decade, Cognizant has quietly built a massive workforce, over 10,000 associates, dedicated entirely to raw data training for the massive tech titans. These workers label millions of images, teaching foundational vision algorithms how to recognize objects.
Right, the brute force human labor required to teach a self-driving car the difference between a stop sign and a pedestrian?
Exactly. But now Cognizant is taking that deep expertise in training vision models and bringing it to enterprise clients. For this specific car manufacturer, Cognizant is building bespoke proprietary AI models trained exclusively on the company's internal physical data.
Internal data.
Yeah, they are feeding the model millions of images of the manufacturer's specific car engine parts, technical schematics, assembly line video feeds, and stress tolerance data.
Wait, why do they need to build a custom model? Why can't the car manufacturer just point a camera at the assembly line and hook it up to a generic vision model from Google or OpenAI?
Because generic models are trained on the public internet. They know what a generic car engine looks like. But a generic model does not know the exact microscopic tolerance required for a proprietary fuel injector designed by this specific manufacturer last month.
Ah, I see.
It doesn't know the specific visual indicators of metal fatigue for that exact proprietary alloy. By training a bespoke model entirely on the client's private, highly guarded physical data, Cognizant achieves a level of precision that off-the-shelf models simply cannot match.
And what is the actual business value of that precision?
It allows the manufacturer to fully automate highly complex physical quality assurance processes on the assembly line. The AI can instantly spot a microscopic defect in a part, moving at high speed, significantly reducing manufacturing errors and recall risks. They are unlocking massive financial value from visual data the manufacturer already owned, but just couldn't process efficiently.
That is fascinating, and it segues perfectly into a massive acquisition Cognizant recently completed that was heavily featured on the call, a company called Astria. How does buying Astria fit into this puzzle of managing the physical world?
Astria is a global IT managed services provider, but they specialize in the heavy lifting of infrastructure. They manage physical data centers, complex enterprise networking hardware, and digital workplace environments. Essentially, they maintain the massive physical hardware that allows the ephemeral cloud to actually exist.
Right, the cloud isn't in the sky. It's just a massive warehouse full of incredibly hot, power-hungry servers in Virginia.
Exactly. And the CFO noted that momentum is rapidly building in this newly acquired division. Astria is going to continue and expand its strategic work with Google. They're delivering services across Google's own corporate engineering environment, including global IT operations and collaboration infrastructure.
Stop and think about that for a second. Cognizant bought a company that is so good at managing complex physical IT infrastructure that Google arguably the most advanced technology company in human history, hires them to help run Google's own internal networks.
It's a massive endorsement.
It really is, and it positions Cognizant to profit not just from writing the software for the AI boom, but from building and maintaining the massive physical data centers required to run it.
They are capturing value across the entire stack, from the physical server racks managed by Astria, to the bespoke AI software written by their frontier engineers, to the final business outcome guaranteed to the client.
Okay, we have gone incredibly deep into the narrative. We see the multi-billion-dollar bookings. We understand the shift from selling hours to selling outcomes. We see the expansion into physical AI and government infrastructure. The story is phenomenal, but, the stock market does not care about what you did yesterday.
Not at all.
The stock market is a forward-looking discounting mechanism. Knowing that they squeezed out a highly profitable Q2, what is management bracing for in the back half of the year? We need to transition to Section 3, management guidance.
This is where the narrative hits a wall of macroeconomic reality. The guidance is highly nuanced, and frankly, management is projecting a very cautious tone regarding top-line revenue growth. Let's look at the numbers. For the upcoming third quarter, management expects revenue to grow between 3.8% and 5.3% year over year in constant currency.
So roughly in line with the 4.1% they just delivered. Steady, but certainly not explosive. What about the full calendar year?
For the full year, they revised their revenue guidance range to 4.0% to 5.5%.
I feel a massive but coming.
The but is the context behind that revision. The CFO explicitly reminded analysts on the call that their previous, more optimistic guidance from earlier in the year was predicated on a specific assumption. They assumed the overall global macroeconomic environment would meaningfully improve in the second half of the year. Specifically, they hoped clients would begin unlocking budgets for discretionary spending.
Let's clearly define the difference between discretionary and non-discretionary IT spending, because it is the fundamental driver of this entire industry.
Non-discretionary spending is keeping the lights on. It's paying for cybersecurity, cloud hosting, and basic network maintenance. A company cannot stop spending on those things without going bankrupt. Discretionary spending is the experimental budget. It's a company deciding to build a highly innovative new mobile app, or completely overhaul their customer data platform, or experiment with a massive new generative AI interface.
Discretionary spend is where the massive high-margin consulting projects usually live, and what drives a CEO to authorize that discretionary spend. It usually comes down to interest rates and the cost of capital. If interest rates are near zero, borrowing money is practically free, so a company will gladly take a risk on a massive experimental IP project. But when interest rates are high, capital is expensive. CEOs become incredibly conservative. They hoard cash and demand immediate ROI for every dollar spent.
Exactly. And Cognizant's management is admitting on this call that the era of tight corporate budgets is not ending anytime soon. They cited elevated macro uncertainty. They are seeing clients scrutinize every single contract. So instead of modeling a magical economic recovery in the fourth quarter, management is baking in a highly conservative assumption. They are projecting that the spending environment remains flat, cautious, and constrained through the end of the year.
Okay, let's look at this rationally. If I am a retail investor and the management team of a consulting firm tells me the global economy is uncertain, our clients are hoarding their cash, and discretionary spending is dead, I immediately assume the company's profits are going to absolutely crater. If the top-line revenue is constrained, the bottom-line earnings usually suffer exponentially. But that is not what happened with their earnings per share guidance, is it?
No, it is not. And this is the most critical piece of financial engineering for investors to grasp from this entire masterclass. Despite the highly cautious revenue outlook, Cognizant actually raised their full-year earnings per share guidance.
Wait, really?
Yes. They are now officially projecting an adjusted EPS of $5.70 to $5.82 for the year. That represents an 8% to 10% growth rate. Previously, they were only projecting 7% to 9% growth.
This is mathematically fascinating. This is the classic corporate setup of underpromise and overdeliver, but it is being executed flawlessly. They are publicly assuming the economy remains terrible. They are projecting revenue growth to be mediocre at best, and yet they are confidently telling Wall Street they are going to generate significantly more profit per share than they thought 3 months ago. How is that mechanically possible without cannibalizing their own long-term growth?
It is entirely possible because management is aggressively pulling two massive financial levers. The first lever we have already spent significant time discussing: structural operational efficiency.
Right. The Project Leap severance packages, replacing manual coders with highly leveraged AI operators, the massive margin expansion from shifting to fixed price outcome-based contracts like the insurance brokerage deal.
Exactly. They have systematically widened the pipe. Even if the total volume of revenue flowing through the business remains relatively flat, their internal AI efficiency means they keep a much larger percentage of every dollar as pure operating profit. They are defending the bottom line through sheer operational discipline.
Okay, so they're running a much tighter, more profitable ship. That is lever one. What is the second lever driving the earnings per share up?
The second lever is aggressive, massive capital return. Specifically, they are executing a colossal stock buyback program. During the second quarter alone, a single 3-month period, Cognizant deployed $1.1 billion in cash to buy back their own stock on the open market.
$1.1 billion.
They repurchased over 22 million individual shares at an average price of roughly $51 per share.
$1.1 billion in 90 days. That is an astonishing amount of capital. Let's break down the exact mathematics of a stock buyback for our retail audience because it directly answers the riddle of how EPS goes up when revenue is flat.
The easiest way to conceptualize it is to imagine a company's total net income for the year as a single large pie. The total number of outstanding shares circulating in the stock market represents the number of individual slices that pie is cut into. Earnings per share is simply the size of your specific slice.
I am tracking with you.
Now, if the macroeconomic environment is tough and the total size of the profit pie stays exactly the same, but the corporate treasury takes $1 billion, buys millions of shares off the open market, and permanently retires them, effectively destroying them.
The total number of slices decreases dramatically.
Exactly, which means every remaining slice, every share held by an investor who didn't sell mathematically, gets bigger. A larger percentage of the company's profit is attributed to each remaining share. By deploying $1.1 billion in a single quarter, Cognizant dramatically shrank the overall share pool. The CFO explicitly modeled this on the call, noting they now expect the full-year weighted average share count to drop to approximately 460 million shares.
So it is a compound effect. You take a business that is becoming slightly more profitable on an operating basis due to AI efficiencies, and you divide those growing profits by a significantly smaller number of shares. The result is that the earnings per share metric mathematically accelerates, completely defying the sluggish top-line revenue environment.
It is a masterclass in capital allocation, but it gets better for the shareholder because they are also returning capital through traditional dividends. The CFO noted that year-to-date, they have returned $1.9 billion to shareholders through a combination of repurchases and dividends, and they are on pace to return roughly $2.6 billion for the full calendar year.
Let's contextualize that $2.6 billion figure. If you look at Cognizant's total market capitalization, the value of the entire company on the stock market returning $2.6 billion represents roughly a 10% total yield. Management is essentially handing 10% of the value of the company back to the owners in a single 12-month period.
It is a staggering yield for a massive technology company. And you have to look at the psychology of the buyback price. Management aggressively bought back 22 million shares at an average price of $51. That is a massive signaling mechanism.
Right. A management team does not burn $1 billion in cash buying their own stock if they think the company's in trouble. They do it because they have access to the internal data, they see the $29 billion pipeline, they see the internal AI efficiency metrics, and they look at the stock price Wall Street has assigned them and conclude, it is irrationally cheap. It is the C-suite essentially shouting, the market is undervaluing our transformation, so we are going to buy the company ourselves.
It is the ultimate vote of confidence. And I want to address a common critique of buybacks here. Often you will hear analysts argue that massive buybacks are dangerous because they starve the core business of necessary research and development capital. Critics argue management is just engineering the stock price instead of investing in the future.
That is a very real risk for legacy companies trying to hide a dying business model. Is Cognizant starving their future to buy back stock today?
The financial data says no. The CFO was very careful to point out that alongside the $1.1 billion buyback, they also deployed $1.3 billion on strategic acquisitions, directly aligned with their AI builder strategy acquisitions like Belkin for government engineering and Astria for data center infrastructure. And despite spending all of that capital on buybacks and acquisitions, they still ended the quarter with a fortress balance sheet, holding $1.1 billion in cash and short-term investments.
Wait, how is that possible? Where is all that cash coming from?
It comes from the sheer cash-generating power of their business model. They generated $459 million in pure free cash flow in Q2 alone. They're currently converting between 90% and 100% of their net income directly into free cash flow. It is a remarkably cash-generative machine, which allows them to aggressively buy back stock and acquire strategic assets simultaneously without taking on dangerous levels of debt.
So, if we synthesize the entire management guidance section, revenue growth will remain steady but highly cautious as clients navigate a tight macroeconomic environment. Operating margins will be fiercely defended and expanded through AI-driven internal efficiencies and structural cost-cutting. The total share count will plunge due to aggressive repurchases, and as a result, earnings per share will jump 8 to 10%. Which brings us to Section 4, the bottom line. We have torn through the data, we understand the shift to outcome-based token economics, we see the financial engineering of the guidance. So what is the play? What is our actionable verdict for the retail investor listening to this deep dive?
Based on a rigorous analysis of the data provided in this earnings call, we are taking a firmly bullish stance on Cognizant, ticker CTSH, for the retail investor.
I am in complete agreement with that bullish assessment, but we need to be incredibly precise about the why. It is not just that they posted a solid quarter with good margins. It is about how their specific business model is positioned to capture value during a period of intense technological disruption. The broader IT consulting market is currently sluggish. We know that 1 in 4 major corporations are halting their AI deployments because they are terrified of the server costs and cannot prove the ROI.
Exactly. Yet in that incredibly challenging environment, Cognizant is demonstrably accelerating. We keep coming back to the financial services sector growing at 12%. That is the defining metric of this entire analysis. When your most sophisticated, technically demanding clients, the massive global banks, are accelerating their discretionary spend with you by double digits while the rest of the economy pulls back, it suggests one indisputable fact. Cognizant is actively taking market share away from their competitors.
They are winning the brutal war for enterprise IT budgets. And they are winning it because they have fundamentally changed the pitch. They are no longer selling the nebulous hype of artificial intelligence. They are not selling generic chatbot licenses. They are selling guaranteed, mathematically underwritten productivity gains. The transition from hourly time and materials billing to fixed price outcome-based contracts is a massive structural competitive advantage.
Let's contextualize that advantage. Imagine a major corporation needs a massive legacy system overhauled. A traditional IT competitor bids $10 million for the project, based on an estimate of 100 engineers working for 6 months. Cognizant walks into the same boardroom and bids $8 million, instantly undercutting the competitor. But Cognizant legally guarantees the outcome, and they use their proprietary internal AI platforms and their trained frontier engineers to complete the massive project for an internal cost of only $4 million.
It is the perfect corporate scenario. Cognizant wins the massive deal because they are cheaper for the client. The client is thrilled because they saved $2 million and transferred the execution risk to the vendor. And Cognizant walks away with a massive 50% gross margin on the project because their AI leverage decoupled their labor costs from their revenue.
It creates a highly defensible moat, at least in the medium term. You cannot replicate Cognizant's infrastructure overnight. They have certified tens of thousands of cloud architects. They are actively training an army of 5,000 specialized frontier engineers. And most importantly, they are deeply embedding proprietary platforms like TriZetto into the core operational plumbing of the healthcare and financial industries. Once an insurance company integrates an agentic AI that automates their adjudication, they are locked into that ecosystem.
So let's make this highly actionable for the listener. If you are sitting at home looking at your brokerage account and you already hold CTSH stock, what does this earnings call tell you to do?
If you currently hold the stock, this report confirms it is a highly stable core portfolio keeper. Management is aggressively defending your equity value with a massive capital return program yielding nearly 10%. The traditional downside risk of holding an IT stock during a sluggish macroeconomic period is heavily mitigated here by their massive free cash flow generation, their disciplined cost controls, and their $29 billion backlog of guaranteed future work. The play is patience. You hold the stock, collect the dividend, and let management use their cash flow to systematically shrink the share pool while they scale these high-margin AI platforms.
And what if you don't own it? What if you are a retail investor looking to start a new position in the enterprise software or IT services sector?
For a new investor, Cognizant presents a remarkably compelling entry point. The core thesis here is operational leverage. They are proving right now, in real time, that they can structurally expand their profit margins even when corporate clients are being incredibly stingy with their budgets. They are building a leaner, vastly more efficient internal engine.
And the inevitable catalyst is the macro turnaround.
Exactly. Eventually, global interest rates will stabilize or fall. The macroeconomic environment will recover. And when it does, the corporate valve for massive discretionary spending will swing wide open. Banks and healthcare companies will flood the market with new IT budgets. When you pour high-octane, double-digit revenue growth into the incredibly high-margin, hyper-efficient AI engine that Cognizant is building right now, their earnings per share will go absolutely parabolic. At $51 a share, management looked at that future leverage and decided the stock was an absolute steal. Retail investors evaluating the sector should strongly consider the magnitude of that signal.
It is a phenomenal data-backed breakdown. We promised a masterclass on the future of software economics, and the mechanics detailed in this specific call absolutely delivered. But as always on our Talk Tickers deep dives, we never want to leave you completely comfortable with a clean narrative. We believe the best way to build wealth is to constantly challenge the consensus. We like to end every analysis with a provocative thought, a structural risk, or a philosophical question for you to mull over and explore on your own that builds on what we've discussed today.
And in this specific case, the lingering existential question for the entire industry revolves around the core concept of token economics that we spent so much time dissecting.
Right. Let's trace the logic of Cognizant's current pitch. They are telling Wall Street, we use artificial intelligence so efficiently that we drastically lower the cost of doing business. We pass a portion of those massive savings onto our clients to win the contract, and we keep the remaining savings for ourselves, which structurally boosts our own operating margins. It is a beautiful, highly profitable model today. But let's look past the next quarter. Let's look 2, 3, or 5 years down the road. What happens to this entire business model if the foundational cost of artificial intelligence, the literal cost of the compute tokens required to run these massive neural networks, effectively drops to zero?
It is not just a theoretical risk. It is a highly probable technological trajectory. As global computing power scales exponentially and highly capable open source AI models flood the market, digital intelligence is rapidly becoming a commoditized utility, much like electricity or bandwidth. If the sheer inference cost of running an agentic AI drops to near zero, the productivity gains generated by the software become almost infinite relative to the cost of operating it.
So here's the structural question for you, the investor, to ponder this week. In a future world where AI compute costs practically nothing, will Cognizant's profit margins absolutely explode into the stratosphere because their internal labor and software costs completely vanish? Or will their massive enterprise clients, the global banks and pharmaceutical giants, realize that artificial intelligence is essentially a free commodity now and aggressively demand 100% of those productivity savings for themselves in contract negotiations? Will they completely crush the traditional IT consulting business model forever in the age of infinite zero-cost intelligence who actually captures the financial value, the consultant who integrates the AI or the client who uses it?
It's the defining existential question for every single systems integrator on the planet right now. And it explains exactly why Cognizant is racing so frantically to lock their clients into highly complex proprietary industry platforms like TriZetto in healthcare. They are desperately trying to build an ecosystem moat before the underlying artificial intelligence becomes completely commoditized.
And that is exactly why we do the deep dive, to keep you looking past the daily stock price, past the dense corporate jargon of the next quarter, and straight at the structural foundational mechanics that are actively shaping the future of the global economy. Thank you for joining us for this special, heavily expanded edition of Talk Tickers. We broke the clock today to get through all the data, but your understanding of the market and your portfolio will be significantly better for it. Stay curious, stay data forward, and we will see you on the next deep dive.